Welcome to Deal Flow. Ryan right here, as always. My guest, and I should say my boss, I guess, the man who drives me daily and just browbeats me to get things done. The one, the only Tim Kotzman. How's it going, Tim?
It's going well. Happy holidays already, Ryan.
Yes, sir. Yes, sir. For those who are not watching or they're listening, Tim was shaking his head. I think when I was saying he browbeats me, he doesn't. He doesn't. He doesn't browbeat me. So, Tim, maybe do a quick introduction of who you are, what you do, and we'll get into it from there.
Sure. So my background is in the land uh, portion of energy, oil and gas specifically. So I started my career as a greenfield acquisition land manager, acquiring oil and gas leases, easements for pipelines, 2D seismic, mineral purchasing. And then along the way, started a few firms backed by family offices and sold deals to those family offices, oil and gas, mineral purchases specifically, along with, working along the way with uh, institutions that are well known that got into the space as things really progressed through the 2008 to mid 2015, 2018 kind of time frame, both in natural gas regions such as the Appalachian, so Pennsylvania, Ohio, West Virginia, as well as the Permian Basin, so West Texas, and then Southeast New Mexico, Lee and Eddy counties specifically. Did some work down in the Eagle Ford Shale of South Texas, again with mineral purchasing, and then um, moved up to New York, started raising capital, um, friends and family, and then also accredited investors, and um, buying and selling mineral deals on a longer time frame, not just flipping deals per se, but holding them for cash flow and then exiting at a opportune time, just looking at the markets and how they ebb and flow. And then that kind of brings us to present day, where we're raising for our fifth fund, um, from accredited investors and qualified purchasers, um, looking to raise the offering amount that's registered as $10 million, and we're probably about 10% of the way there on that. So we'll continue raising for that over the next 3 to 6 months and then deploy that capital. And in the meantime, always looking for deal flow as far as any oil and gas mineral deal, whether we take it down for our own account or for one of our series of funds.
Okay, great. So let's talk about the capital side in a second, but we've talked on the podcast in the first few episodes mainly about M&A transactions, and of course, you can hear if you follow the oil and gas news, acreage getting swapped and stuff in large M&A deals. But for what you're doing, there's a ton of stuff in the mineral space, things you can buy, ways you can get in. Maybe super focused for those who aren't familiar. They don't know anything about oil and gas. They go, oh, you got oil and gas under the ground. I can buy it. You're buying, in practical terms, you're buying what and why is that of interest to you?
Definitely. So we're buying specifically, and the definition varies from state to state, whether they are considered oil and gas rights, meaning oil and natural gas rights, or mineral rights. The legal definition varies from state to state. Um, and oil and gas or minerals would be that specific uh, right to property in the bundle of sticks, where people are very familiar with surface rights. When you buy your house, you own your backyard, your front yard, your side yard, and the property that your house is on. So those are the surface rights. So that's what we may deal with a surface pipeline easement issue, or project. Um, timber rights, when maybe you own some woodland and it gets select cut, or um, you know you're developing it from time to time to optimize it, so you own the right to those trees and whatever you could do with it as far as timber rights, air rights, maybe more in more urban areas. And then coal rights. Some people, especially in the Appalachian or different coal regions, might be familiar. But to your point, yeah, if someone's not really directly in a shale region, Oklahoma, Texas, North Dakota, where they themselves have been approached for to sign an oil and gas lease, or maybe they inherited an oil and gas lease on family property, or if they don't run into someone in the industry, whether it's a land manager or a petroleum engineer or a geologist. Um, yeah, it's kind of this niche uh, industry of land rights, mineral rights within oil and gas that, um, as I have the opportunity to speak with folks in, I mean, really had the pleasure of working with people in on the capital side, from California to Chicago to Maine to Florida to Texas. And in California, a lot of individuals are more um, familiar with venture capital or technology, and if they're not in an oil or gas region, they just kind of didn't know that it existed. And you know, lots of different analogies that we can try to use to explain it, as far as like a rental property. But the wells do come on strong and then kind of decline on a ski slope. But why we would be interested in them is, as we're kind of chasing these operators around, seeing where they have filed of record in the county courthouse, hey, we are have what they call a declaration of pooling. We've unitized this 100 acres or this 600 acres. And it again varies from state to state, but in many states, when they say, hey, we have recorded that we intend to drill in this area, and this is us going through the permitting process, they have 2 years on the clock in many cases in order to drill, or that permit will expire. So that's our first public notice um, of activity in an area. And based on the engineering and the fact that the core of the core, as we call it, in these areas where there has been development, there is a record of production. So there may be marginal wells, there may be gushers, but we kind of have a range of what we think the wells will do. And if we have some sort of what we call line of sight, where we feel like one or several wells may be developed within the next 6 months to a year or two, that's really what we're focusing on in order to purchase a property, acquire a property that is already subject to an oil and gas lease and is going to be developed in the near term. We can collect the oil or natural gas royalty payments based on the current commodity price that are paid from owning that property. And then if they like that area and they come back and they permit additional wells to be drilled at a later time, maybe a year or two down the road, with and maybe they'll come back every 1 or 2 years and continue to drill a few wells. That's where we can enter and exit the process, where we can enjoy the royalty cash flow from one or several wells. And then when we look to sell the property, either by itself or divesting an entire portfolio, we can say, hey, the firm that we sell the portfolio to can then underwrite those additional wells that have been permitted but haven't yet been drilled and turned in line. So that's why it's attractive to us,
Yeah.
and
So
kind of the strategy, if you will.
yeah. So make sure I follow along. Some producer, whether it's Exxon or someone we never heard of, they go out and they find an area that they think is advantageous. You're not ready to go in just yet because it might not be advantageous because they're like anyone else to get things wrong. And then they start drilling. And once you've kind of seen there's ways you get these records that the wells are producing and kind of fits your thesis, then you say, okay, we want to go buy the acreage from whomever owns it. So it could be the guy that's right on top of it. It could be someone across the country, but someone somewhere owns those mineral rights, those acres. So you're going buying it from them because if Ryan owns it, in this case, you call Ryan up, you buy it from Ryan. Well, now Tim owns it, but the thing that Tim really wants is the lease that's attached to it, which means that at some point within 2 years or so, they're going to go drill, and you can kind of already know, okay, if they do drill in this area like they're supposed to, then it's going to cash flow. Or maybe you bought it and they've already started drilling. So you've kind of hedged yourself into a realm that you've avoided the risk of a dry hole because you know what the field will do. Is that kind of a good summary?
Yeah, it's a great summary. And in fact, it hits on the reality that it doesn't have to be an undeveloped property that we're acquiring. It could be a currently producing property where we look at the check stubs and we make an offer based on discounting that existing cash flow. Because if it's, that's even more de-risked um, from the standpoint of we don't have to guess whether it's going to be a really well producing or a marginal uh, development. So yeah, I think sometimes some investors or some landowners, buyers and sellers, get this idea in their mind that it's one or the other. You have to sell all 100 acres or none of it, which isn't the case, or that we're trying to buy something that's completely undeveloped, and that we wouldn't want to purchase something that's currently producing. So we can buy 1 acre, we can buy 100 acres, we can buy something whether it's producing or non-producing. So that really is not just unique in that some people have never heard of it, but
Mm.
very unique in that if we are looking to put $10 million to work, we can buy a portfolio of 1,000 acres, or if we're trying to put $1 million to work, we can buy a portfolio of 100 acres. And these interests, especially in certain areas, are so um, severed because of um, either family uh, properties being diluted in shares as families grow larger through the generations, or for other reasons. It's just a very unique way to not have to put a certain amount of capital to work, or be limited, because there are hundreds of thousands of individual mineral owners across the nation.
And one thing that you said there, of course, if you follow the news about oil and gas, you'll hear this term, decline, decline rate and the curve rate and all this stuff about these shale wells. They ramp up and they drop down pretty quick. Most time we talk about deal flow, buying stuff, acquiring stuff. You're looking for stuff because it's going to go up in value. But here the wells are going down. So why is it advantageous to go buy something that's going to produce less than it once was? It once was.
Great question. So um, really partly goes back to us collecting royalty payments based on the wells that are currently being developed. And then if we hold it on a long enough time frame, the operator may drill additional wells where, instead of one well producing, if there's two or three or five or 10 wells producing on a certain property, um, you have that staggered and overlapping cash flow over time. And again, in the scenario that at well 3 or well 5 or well 6, we look to divest of the property. We're really buying and selling it um, during that development life cycle. So we can, if we have our capital back in 5 years, let's say, and then we sell the property because you're able to underwrite additional development that's not quite turned in line yet, then let's say we sell the property for what we bought it for, then that's, targeting a 2x in 5 years as an example. And that's, um, reasonable from an investment standpoint. It's attractive to a lot of investors, but it's also a long enough time frame that if someone has 100 acres or they have 20 acres, they want to sell a quarter of it just to take some risk off the table, or because they have another need for capital, then we're able to be an outlet for them, and really turns out to be an opportunity for both sides.
And one of the things I like about this space is, unlike buying a rental property or stuff like that, or a business or whatever, you do have some risk, which we're going to talk about. But if something goes terribly wrong and oil leaks all over the ground, or if there's an explosion on the well site, that you're not in that part of the acquisition process, right? So you just own land that someone's sucking it out of the ground and they're paying you for it. All the the risk for environmental or work labor damages, stuff like that, you're 2 or 3 levels away from that. So your real risk, as I understand it, is price fluctuation, or they abandon the well for some reason. What are your risks? Because you don't have those traditional risks like with a rental property, the house. There's a hole in the wall. You got to pay to go fix this. You don't have to pay for those kind of things. So what are your risks here?
So I guess I'll start by saying, we certainly internally, being in the industry for about 15 years, um, do have um, know the risk profile. We do disclose the risk profiles in the private placement risk factors that are, number maybe a dozen pages or more, so certainly more than several pages of risk factors from, as you said, if the well doesn't produce, if it's shut in. We had a well where we received a $1 per year shut-in payment, I believe from Exxon in April or May of 2020 for obvious reasons. So there are, many, many risks that are disclosed to our limited partners when we do fund projects. Um, but the operational risks are not the side of the business that we're in, to your point. So the two variables that we do contend with are development timing, when are they going to drill the wells and produce them, and commodity price. So what is the price at the wellhead of oil and of natural gas at any given time throughout, for each month that's producing.
Yeah, and I guess that's kind of an interesting risk because that's the one thing you can't control, right? So you could improve safety measures and mitigate risk on something, but this is really the one thing that you just can't control. If the Saudis and Russians and Chinese do something over here, or the U.S. overproduces over there, like you're really at you have an advantage that your risk is not something safety related or construction related, but then the flip side is that the risk is these big global macroeconomic things that are really outside of your control. So if you're sitting here, you go, man, yeah, it's interesting, but how do I how do I know that getting into this space, looking for deals in this space, or investing with someone like you in this space is fits my investment portfolio, my investment thesis? What is it that you see with investors that you work with, or when you decide to get in the space, like why this over some other asset class?
Yeah, I guess without going into the exact return profiles, on a marginal deal versus a home run deal, it's attractive because it could be, um, you know, double or more what someone might see in a traditional residential real estate, or residential multifamily strip mall sort of return in traditional real estate, surface real estate. It's also interesting because uh, no one knows what's going to happen later today or tomorrow, but um, when you look at the dynamics globally and you see OPEC and you see, one thing I think is very interesting is, we do have a strategic oil reserve here in the United States. We do not have a strategic natural gas reserve. We can drill more wells, but we don't have that reserve that we can strategically or politically, dip into, so to speak. Um, so, I mean, as far as someone's investing appetite, thesis, outlook, risk tolerance, I mean, it's certainly an individual, personal decision. I enjoy, because it's such a small niche industry, just educating and talking to people about what the risks and the opportunities are in the space. And um, again, we don't know what the price of oil or gas is going to be later today, but with OPEC, with the fact that if the price does go low because of uh, some worldwide outbreak, these operators are shutting in wells, and I just historically I'd just be surprised based on the historical data if oil for any extended period of time is really outside of that 70 to $100 range. And certainly that'll go up over time due to inflation.
Mhm.
But you know, you look a couple decades ago and oil was 40, 50, $60, and you look now and it's 70, $80. It just doesn't seem to on a long enough time scale change that much in the same way that the Fed targets 2% inflation. Well, the 108-year average inflation rate ending in 2021 is 3.24%. So it's just interesting what you hear in the media and what grabs headlines versus what the really long history will tell you about inflation or the price of any commodity.
Okay. And so you founded Jubilee, CEO there now, on Fund 5, correct?
But number five, yep, we're
Fund 5.
raising capital and then we'll deploy that for Fund 5. Correct.
Right. And so, from your we talk about deal flow, you're looking for, I guess, deal flow on two sides, right? So you're looking to go acquire stuff, but you're also looking for people to come and invest alongside in your funds.
Correct. Yep. Always looking for deal flow and looking to develop new relationships with landowners, with other mineral managers, and then establishing relationships with accredited investors, qualified purchasers, family offices, and from time to time, institutions. We may make sense to partner together on the capital side or on the deal side, just depending on what the opportunity is.
So from an investor standpoint, you kind of talk about some of the risk and stuff, but there's, you know, these are people who are accredited only. Is that what you're doing right now?
Correct. Yep. The current offering is open to accredited investors and qualified purchasers. So, um, yeah, that is who we're registered to do business with right now for this current fund.
Okay, so we're sitting here 10 years from now. You said that there's kind of this uh, talk about inflation and oil and gas prices and stuff. Where are you at? Where's Jubilee at? Are we on Fund 27, Fund 10? Do you expect things to increase? More funds? Is one a year, two a year, kind of the good pace for you guys? What are you looking to do over the next decade or so?
Yeah, I think we want to continue being strategic with both deal flow and capital. So, 10 years from now, maybe we're on Fund 12 or Fund 15. But the trend seems to be that as we continue to develop relationships, raise capital, and execute on these fund vehicles, the amount of capital we're raising is larger. So if we raise, a certain amount, it may take us a year or two or more to deploy that capital. So we wouldn't necessarily be, um, raising or doing a separate fund vehicle once or twice a year. I think the numbers of Fund 5 versus Fund 12 will probably slow down as we raise, similar or larger amounts of capital and then thoughtfully put that to work. But I see this as something that is certainly has the historical track record, and even with alternate and renewable sources of energy, something that will continue to be, um, you know, something that has a position in the marketplace for, well over the next 1 to 2 decades. But, um, I certainly think over the next 5 to 10 years, that's something we can keep on building slow and steady.
What's been the biggest lesson you've learned, or most surprising lesson, maybe going from the in the field side, going out and kind of doing it, to being your own, having your own fund, being your own fund manager, raising capital? What's been the biggest shift there for you?
I think the biggest lesson, it's a great question, by the way. I think, at least what comes top of mind is, some things that are on the deal side and the capital side, because it's just business and it's just life in general, whether it's professional or personal, is communication and consistency. So whether it's negotiating with a seller on the deal side, or um, not just raising capital, but investor relations and communicating, it's really having a system in place to be consistent, where if you're going to send out an update, I'm sending it out on the same frequency, the same schedule, on a consistent basis, so that people don't need to wonder, oh, is it going to be on this day or is it going to be on that day? So just clear communication and consistency, and managing some of that. So, for example, some of the wells are, or not some of them, all of the wells, whether they're natural gas or oil, are on this steep decline curve that looks like a ski slope. So some quarters are better than other quarters from a cash flow, distribution, royalty payment standpoint. So to the extent that it makes sense, um, you know, I try to be thoughtful about, if we have a huge quarter, maybe we'll distribute, you know, a significant percentage, but not 100% of that, and try to smooth it out at least a little bit, so it doesn't um, feel like this bungee cord up and down quarter to quarter from the investor standpoint. So communication and consistency, I think as humans, we all enjoy is being in a relationship with somebody who's consistent. Um, and to the extent that that's practicable, I think that's really important.
Okay. JubileeRoyalty.com still the best place to send people to. Anywhere else you want us to connect you with the listeners at?
I'm on LinkedIn, uh, X, formerly known as Twitter, and yeah, JubileeRoyalty.com. Yeah, all great places to connect.
Okay. Well, Tim, it was great to have you on. Always good talking to you, friend. And we'll talk to you soon, brother.
Thanks so much. Great to talk to you.